we don't want to buy equities where our real expectancy is below 10%. Now that's true whether short rates are 6% or whether short rates are 1%. We just feel that it would get very sloppy to start dipping below that, and we would add. We feel also obviously that we will get opportunities that are at least at that level and perhaps substantially above. So there's just a point at which we drop out of the game, and it's arbitrary. We have no scientific studies or anything, but I will bet you that a lot of years in the future, we or you will be able to find equities that you understand or we understand, and that have a probability, the probability of returns at 10% or greater. Now, once you find a group of equities in that range, now and leaving aside the problem of huge sums of money which we have, then we just buy the most attractive. That usually means the ones we feel the surest about. I mean, as a practical matter, there's just some businesses that possess economic characteristics that make their future prospects far more predictable than others. There's all kinds of businesses that you can't remotely predict what they'll earn, and you just have to forget about them. But when we have over time gotten very partial to the businesses where we think the predictability is high, but we still want a threshold return of 10%, which is not that great after tax anyway. Charlie, do you want to comment on that portion of that question first?
Yeah, I think in the last analysis, everything we do comes back to opportunity cost. But to some extent, in fact, to some considerable extent, we are guessing at our future opportunity cost. Warren is basically saying that he's guessing that it's in due course to put out money at pretty attractive rates of return, and therefore he's not going to waste a lot of firepower now at lower returns. But that's an opportunity cost calculation. And if interest rates were to more or less permanently settle at 1% or something like that, and Warren were to reappraise his notions of future opportunity cost, he would change the numbers. Like Keynes said, what do you do when you change your view of the facts? Well, you change your conduct. But so far, at least, we have hurdles in our mind which are basically, well, they involve implicitly future opportunity cost.
Right now, with our $16 billion that's getting 1.25% pre-tax, that's $200 million a year. We could very easily buy governments due in 20 years and get roughly 5%. So we could change that $200 million a year to $800 million a year of income. And we're making a decision, as Charlie says, that it's better to take $200 million for a while on the theory that we'll find something that gives us 10% or better than to commit to the $800 million a year and then find that in a year thereabouts, when the better opportunities came along, that what we had committed to had a big principal loss in it. But that's, that's not it's not terribly scientific, but all I can tell you is in practice it seems to work pretty well.
And years ago, when Warren ran a partnership, and to some extent the partnership that I ran operated in the same way, we implicitly did what you're suggesting, in that part of the partnership funds were in so-called event arbitrage investments, and those tended to generate returns occasionally when the market generally was in the tank, and alternative investments would more mimic the general market. So we were doing what this academic theory prescribes, 40 years ago, but we didn't use the modern lingo.
Yeah, we've got some preferences for having a lot of money coming in all the time, but we do go into insurance transactions with huge volatility, which could mean that a big chunk of money could go out at one time or in a very short period of time, and we won't give up a lot in expectable return for smoothness. But if you give us a choice of having money come in every week and the same present value of money coming in very lumpy ways that we wouldn't know about, we would choose the smooth. But if you give us a choice of a higher present value for the lumpiness, we will take the lumpiness. And that's usually the choice that's usually, we get offered that choice. And other people value smoothness so highly that we do get a spread, in our view, for lumpy returns. We are writing, and then we're going to close this up, but you will read a lot, or you may hear a lot. Maybe you've heard it already. Pepsi-Cola is having a contest. They're going to have a drawing in September. The contest goes through a lot of little phases, but in the end, there's going to be one person who's going to have one chance in 1,000 of winning $1 billion. That $1 billion will have a present value of maybe $250 million. If whoever gets to that position hits the number, we will pay it. And we don't mind paying out $250 million as long as we got paid appropriately for us. And that would create bad cash flow that particular week. We're willing to, maybe even for 2 weeks, we're willing to assume that for a payment, and very, very few people in the world are, even those that can afford it. We would even assume it for $2.5 billion present value. We'd want more proportionally to assume it for that. But Charlie and I think, would agree that we would take that on if we got paid well enough for it. We wouldn't do it for $25 billion, but we will do things, and therefore, we get the calls on that sort of thing, and that is more profitable business over time than bread and butter business. It also can, it can lead to you having an intense interest in watching the television show when the drawing takes place, making sure who draws the number too. Charlie, you have anything to add? And then we'll.
Yeah, but once you're talking about opportunity cost that's personal to yourself and your own situation, size, you've departed from modern finance totally, and that's what we've done. We're intelligently making these guesses as best we can based on our own circumstances and our own abilities. I think it's crazy to do it based on somebody else's circumstances and somebody else's abilities.
Thanks for coming, and I hope we see you all next year.
To have the absolutely most fortunate people paying practically no income taxes, I just think it's unacceptable. I think there has to be some fairness in some of these arrangements, even if there's some theoretical argument that the economy might work a little better some other way.
Yeah, there are IRAs now, obviously, that work very well for people with modest amounts of dividends, that they're getting tax deferred for a very long period of time, which has huge benefits. The big benefits of exempting dividends would go to fellows like me and Charlie, and that's not going to stimulate the economy. It's going to stimulate us, and it's going to result in us sending a very small percentage of the income of our income to Washington compared to what the people working in our shoe factories send. And that when somebody says, what did you do during the war, Grandpa? I'm not sure that's what I want to explain to them.